Hi there. Hi, everyone. My name is Yasir Gulfraz and I'm your tutor for today's learning outcome, understand the regulatory framework for financial reporting. So anyone can see my screen, or can you
Yes.
hear me?
Yes, we can see.
Please do let me know if there is any issue. So okay. So just can I have your introduction, just short, Faiza first?
Yes, sure. My name's Faiza Naz. I'm based in the Midlands. I'm accounting and finance graduate, and I've recently opened up my own practice.
Okay. And what about Eli?
I'm living in Bournemouth, Dorset. I've just opened my own practice as well.
Okay. Anyway, let's start with our first learning outcome. In today's lecture, we'll explain into a important aspect of the financial accounting regulatory framework for financial reporting. I hope you know most of things, Faiza. I think so.
Um, I'm sure I should
Okay.
have the basic. Yes.
Okay, anyway, this is important foundation for understanding how financial information for understanding is understanding how financial information is prepared, presented, and used in various business contexts. So let's get started.
Okay.
Purpose of accounting standard. Any idea? Anyone? If you can explain.
Um,
Okay.
um,
Yes.
I said you can carry on.
Okay, no
Well,
problem.
to keep everyone honest, I show true fact of a financial statement.
Yeah, that's correct. And also in the world of financial reporting, accounting standards hold incredible significance. They are not just a set of rules, they are the building blocks that ensure financial data makes sense to all of us. Okay. So
Okay.
accounting standards provide a universal language that guarantees consistency, comparability, and transparency in the world of financial statements. So here we'll explain the depth of why accounting standard matters so much. So ensuring uniformity, accounting standards provide a set of uniformity ensures that businesses follow consistent practices in reporting financial data, enabling stakeholders to compare financial information across different entities. Picture this like different businesses following different rules for financial reporting. Okay. So accounting standards set up into bring order, they lay out universally accepted rules and guidelines that businesses must follow when preparing their financial statements. This uniformity ensures that financial data is presented in a constant manner, allowing us to comparing uh, applies to applies even if the businesses are a different as apples allowing us to compare apples to apples even if the businesses are different as apples and oranges. So facilitating cross-border comparison in a globalized business landscape, entities often operate across borders. Accounting standards bridge the gap between diverse accounting practices, making it possible to assess the financial health and performance of companies regardless of their geographic location. So in today's world, companies spread their wings across borders. Different countries often have different ways of doing accounting. That's where accounting standards come in. When create a bridge that spans the gap between various accounting practices, This means we can evaluate companies' financial health and performance no matter where they are on the map. Okay.
Okay.
So next is providing relevant and reliable information. That's mean accounting standards are not just about numbers, they are about truth and reliability. These standards aims to produce financial statements that truly reflect a company's financial positions and performance. This transparency is a goal for investors, creditors, and all the others folks interested in companies' financial health, other folks or any other stakeholders. With accurate and reliable financial data, they can make informed decisions that shape the future.
Yeah.
Okay. So, any idea about purpose of accounting standard?
Yes, to give a clear picture of, like a true picture of the company's.
Or company's financial health.
Yeah, that's right.
That's correct. So next is a minimizing information inventory by enforcing consistent reporting, accounting standards, reduce information asymmetry between management and external parties. This reduces the risk of misinterpretation and manipulation of financial information, fostering trust and accountability. Next is ensuring accountability. So in accounting standards are not just about maths or not just about numbers. They are about ethics too. So they hold companies accountable for their financial actions by setting guidelines for how financial transactions are disclosed. These standards help prevent financial misconduct and unethical practices. This encourages businesses to walk the path of responsibility and integrity. Facilitating effective corporate governance. Think of a company as a ship. So the board of directors and audit committees are the captains responsible for steering the ship in the right direction. But how can they do that without accurate navigation tools? So that's where accounting standards come in. These standards provide clear financial information that helps the captains or the boards evaluate the ship's performance and make decisions that keep everyone on board safe. Okay.
Okay.
So complying with legal and regulatory framework, I believe that you heard about it, very common one. We can't ignore the law, can we?
No.
Okay. Accounting standards often go hand in hand with legal and regulatory requirements set by governments and industry regulations. These standards ensures that financial statements meet legal obligations, reducing the risk of facing fines or legal disputes. So enhancing credibility, it is very important thing, especially in finance. Compliance with accounting standards add an extra layers of trustworthiness to financial statement. When external auditors give their stamp of approval, it's like having an expert vouch for the accuracy and compliance of financial reports. So this boosts confidence in the information presented. Accounting standards are not just rules written on paper, okay? They are the backbone of transparent, reliable, and comparable financial reporting. Working knowledge of IFRS or small and medium enterprises. So you know that international financial reporting standards for small and medium size entities. So is a streamlined set of accounting principles designed to meet the needs of smaller financial reporting that is both practical and relevant. So tailored for smaller entities, IFRS for small and medium entities, enterprises is a framework that stands as a guiding light for small and medium-sized businesses. It is like bespoke suite designed to fit the distinct characteristics and reporting requirements of these entities. So this framework simplifies the complexity of financial reporting, making it more manageable for businesses of a smaller scale. Then it comes to the global recognition. So while the full IFRS can be rather usually geared towards large companies, corporations, the IFRS for small and medium businesses has carved a niche for itself globally. Its applicability to smaller entities has been acknowledged and accepted internationally, ensuring that financial reporting remains consistent and comparable regardless of the jurisdiction, various jurisdictions. Can you hear me?
Yes.
Yes.
Okay. So working knowledge of IFRS again. So accrual basis of accounting. I hope you guys knows about accrual basis of accounting. Anything if you want to tell me?
No.
Need a recap.
Okay. Within the framework, we encounter the accrual basis of accounting, which means transactions are recorded when they occur, irrespective of the flow of cash. So this approach grants a more accurate, portrait of an business status or entity's financial status and performance. So providing clear picture of its operations. Okay. So next is a historical cost convention. IFRS for small and medium businesses generally uses historical costs as the foundation for valuing assets and liabilities. So this simplifies the valuation process, curbing the need for intricate fair value assessments and promoting more straightforward approach to financial reporting. So statement of financial position, previously known as balance sheet, you know that, which shows assets and liabilities.
Yep.
Okay. So this framework, a presentation of a balance sheet, think of it as a snapshot that captures an business's assets, liabilities, and equity or capital at a given point in time. So assets and liabilities are often categorized as current and non-current assets, enabling stakeholders to gauge an entity's liquidity and long-term stability. Then it comes to the statements of comprehensive income.
Can I ask you a question?
Yes, sure.
Does all businesses need to have balance sheet, even
Yes.
though they are very small?
Yeah, even they are very small, they must show their balance sheet. Okay.
Okay.
It's a requirement by law.
Okay.
So next one is statement of comprehensive income. IFRS for SMEs prescribes the presentation of a statement of a comprehensive income, which includes both profit or loss and other comprehensive income. So this provides a holistic view of an entity's financial performance.
Okay.
So simplified measurements principle. As we navigate the framework, we come across simplified measurements principle. For instance, when it comes to assets and liabilities like property, plant, and equipment, IFRS for small and medium businesses offers flexibility. Entities can choose between the cost model or the revaluation model, streamlining the measurement process. Revenue recognition, recognizing revenue is a cornerstone of a financial reporting. IFRS for small and medium businesses sets out clear guidelines for this critical aspect. So revenue is acknowledged when there's a high probability that economic benefits will be realized, and when these benefits can be measured reliability. The frameworks covers revenue recognition from various sources such as sales, services, interest, royalties, and dividends. Disclosure requirements. So while the framework simplifies many reporting aspects, it does not compromise on transparency. A disclosure requirement ensure that entities provide relevant, reliable, and comprehensive information to stakeholders. These disclosures are essential for fostering trust and enabling stakeholders to make informed decisions.
Okay.
Okay. Can you see my screen, or can you hear
Yes,
me?
yes.
Really? Okay. I have to ask, because sometimes there's a technical issues. So, okay. So next one is simplified disclosures. Compared to full IFRS, for SMEs offer simplified disclosure requirements that are more manageable for smaller entities. This helps avoid undue administrative burdens while still maintaining the integrity of financial information. So, practical application of international financial reporting system for small and medium entities isn't just a set of rules. It's a tailored approach that empowers smaller businesses of communicate their financial health transparently and consistently. So the principle of IFRS to small and mediums lays the foundation for accurate representations, comparability, and credibility in financial reporting. Okay.
Okay.
Yep.
So next one is working knowledge of IASB, independent body that accounting standards known as IFRS. Its role is to create high quality, globally accepted standard that enhance transparency, comparability, and consistency in financial reporting. So structure and governance. Standard setting authority. Anybody knows about? Have you heard about IASB? There are two
Yeah.
different. Okay.
I think it's the International Accounting Standard Board.
Yes, that's correct.
Yeah.
International Accounting Standard Boards, or IASB, and it is impact on financial reporting. The IASB is a global powerhouse responsible for developing and promoting international financial reporting system, or IFRS, which play a vital role in harmonizing financial reporting practices worldwide. So Here we will discuss the key aspect of IAS, explore the practical implications in context of the in UK. So standard setting authority, the IASB serves as an independent body. That's all about setting accounting standards, specifically IFRS. Its mission is to create top-notch, globally accepted standards that boost transparency, comparability, and consistency in financial reporting. And then structure and governance. So it's the IASBs are composed of a diverse group of experts hailing from various fields. So we are talking about auditors, academies, and people who prepare financial statements. So they have got a due process handbook that ensures an open and inclusive approach when crafting these standards. A practical implication in the UK, adoption of IFRS in the UK. So here we'll talk about how this connects to the UK. Given that the UK is a major financial hub, it's widely embraced IFRS. This applies to both listed and non-listed companies. So this adoption brings some major perks like enabling cross-border companies and attracting international investors familiar with the international financial reporting standards-based financial statements. So UK GAAP transition to IFRS to IFRS in the past, the UK used to own set of GAAP, which is generally accepted accounting principles, or UK GAAP. So, however, plenty of entities have made the shift to IFRS to align with global reporting standards. This move not only enhance their international credibility, but also aligns them with the broader financial world.
Okay.
Basically, here is talking about, that different standards, okay, financial reporting and international standard board, okay.
Okay.
So revenue recognition, IFRS 15. So example of an international standard board is IFRS 15, which addresses revenue recognition, okay. For example, it focuses on revenue recognition. UK companies that follows financial reporting system 15 use a 5 setup model to recognize revenue from contracts with customers. This uniform approach ensures that revenue reporting stays accurate across different industries. Then leases, 16, IFRS 16 clause. Here's another one, which is IFRS 16, which deals with a lease accounting. So in the UK, entities must adhere to this standard, recognizing lease liabilities and corresponding right of use assets on their balance sheet. So this adds transparency and gives us a clear snapshot of an entity's financial position. Global comparability. This is IASB standards often offer UK companies something valuable. Global comparability. These standards enable UK companies to present financial information that's easily comparable with businesses worldwide. Then reduce complexity. adopting uniform standards like IFRS streamlines financial reporting. The UK's alignment with these standards simplifies process and reduces the need to navigate multiple reporting frameworks, ultimately boosting efficiency. A key accounting concepts. Any idea if anybody can tell me about key accounting concepts? Faiza or
Being consistent and, yeah.
Yeah, that's correct. Also, accounting concepts are fundamental principles that guide the preparation and interpretation of financial statements.
What do you mean by mental?
Sorry?
What do you mean by mental?
Fundamental.
Oh, fundamental. Okay, sorry. You just got cut off and then I just heard.
No. You can see my screen as well. Accounting concepts are fundamental principles that guide the preparation and interpretation of financial statement. So these concepts provide a framework for presenting financial information accurately and consistently. Anybody can hear me?
Yep.
Yes.
Okay. So prudence suggests that when uncertain events occur, accountants should anticipate possible losses but not anticipate gains. For example, in the UK, a company may set aside reserves for potential bad debts even before they materialize. So I believe that you heard about bad debts. It's a very common word. Is it on Pfizer? Or if
Yes.
you are practicing or rely,
Yep.
you are okay. So then is a consistency. So consistency dictates that accounting methods should remains the same from one period to the next. So this ensures that financial statements can be compared over time. For instance, if a company chooses to value its inventory using the FIFO, this is a depreciation system. I believe you heard about FIFO and LIFO.
Yep.
And yeah, it's a first in, first out, or
First in, first out, and the other one was last in, first out.
yeah, last in,
LIFO.
first out. Yeah, that's correct. So method. So it should continue to use this method consistently.
Okay.
Going concern assumptions. So we have the going concern assumptions. This concept assumes that a businesses will continue its operations for the foreseeable future. In the UK, this influence how assets and liabilities are valued. For example, when assessing the value of property, accountants assume it will continue being used for business operations rather than being sold immediately. So materiality suggests, basically this concept emphasizes the significant information should be disclosed in financial statements, while immaterial information can be omitted. In the UK, if a company experiences a minor financial event that wouldn't significantly impact users' decisions, it might choose not to disclose it. So this ensures. Sorry?
What do you mean by that?
Which one? Materiality?
No, yeah, materiality. You said, in the example, it says if a company
Yeah,
in the
if a
UK
company's UK experiences a minor financial event that wouldn't significantly affect user decisions, like let's say some few things which bad debts not affect on your big decisions, you don't need to choose disclose it, like some assets or some liabilities like a minors which are that personal drawing or personal related, so you don't need to mention or you don't need to disclose. Okay. When like you are some people selling companies, or might be there are personal kind of drawings, materials, you don't need to disclose. Okay. So matching matching principle. The concept requires expenses to be recognized in the same period as the revenues they generate. In the UK, manufacturing company will record the cost of goods sold at the same time it recognized revenue from the sale of those goods. Okay. So key accounting, then money measurements. Money measurement principle is another important concept. It states that only transactions that can be expressed in monetary terms should be recorded, while employees' morale is undoubtedly important. It is challenging to measure in monetary terms. As a result, it isn't directly accounted for in financial statement in the UK or elsewhere. Realization principle, according to the realization concept, revenue is recognized when it is realized or realizable and earned, okay, regardless of when cash is received. For instance, in the UK, consulting firms recognize revenue when services are completed, even if the client has not paid yet, okay? So when you provide your services, that means your revenue is realized or it's already been earned, okay?
Okay.
Like when you give services to your client, Pfizer or LI, but they that means you already provided your services. So your revenue is already earned, okay? Whether they will pay you later or straight away.
Okay.
So historical cost dictates that assets should be recorded at their original purchase price. So this principle is widely applied in the UK when valuing assets such as equipment or property over time. Assets might appreciate in value, but they are still reported at their historical cost. So the recorded at their original price, but then the depreciation concepts, we use depreciations, okay? After 5 years and 2 years and 3 years, so we decline price, but we use record as a original price or historical price. Okay, so practical benefits of applying accounting concepts. Accounting concepts serve as guiding principles that ensure the accuracy, consistency, and transparency of financial reporting. Applying these concepts in the UK context enhances the quality of financial information presented to investors, creditors, and other stakeholders. By adhering to these principles, companies can make more informed decisions and build trust among their stakeholders. So it's a same that by applying these concepts in the UK and beyond, companies ensures accuracy, consistency, and transparency in their financial statements. So this in turn enhances the quality of information presented to investors, managers, creditors, and all other stakeholders. Key accounting principles here are we already discussed, relevance, reliability, comparability. So accounting principles are financial fundamental guidelines that ensures the quality and integrity of financial reporting. So these principles help create meaningful and consistent financial statements that provide valuable information to stakeholders. Relevance demands that financial information should be capable of influencing users' decisions. In the UK, consider a retailer disclosing its sales figures during the holiday season. This information is relevant to investors assessing the company's performance during a crucial period. Then reliability, on the other hand, emphasizes the necessity of accurate and trustworthy financial information. In the UK, auditors play a very important role. They, auditors play a vital role in ensuring the reliability of financial statements through rigorous examination and verification of the company's records. Then it comes to the comparability. Comparability requires that financial information should be presented in a consistent manner over time and across different entities. In UK, consider a bank disclosing its loan portfolios, compositions, and performance metrics, allowing investors to compare its performance with other banks. Can you guys see my screen?
Yep.
Faiza?
Yes, I can.
Okay. So then understandability means that financial statements should be clear and comprehensive. Should be clear and comprehensible to users with a reasonable knowledge of business and economic activities. So in the UK, companies provide explanation and footnotes to help users better understand complex financial data. Relevance in actions. A UK-based tech company disclose its research and development expenses, highlighting its commitment to innovation. This information is relevant to investors assessing the company's dedications to staying competitive and driving future growth. Then reliability in action. UK retailer engaged an external auditor to review its financial statements. The auditor's endorsement enhances the reliability of the company's financial information, providing stakeholders with greater confidence in the reported figures. UK retailers collaborates with external auditors to review its financial statements. So the auditor's endorsements bolsters the reliability of the financial information with greater confidence in the figures presented to stakeholders.
Mm-hmm.
So comparability in action. Two UK pharmaceutical companies present their financial statement using a common chart of accounts and reporting format. So this facilitates easy comparison between the company's financial performance, aiding investors in making informed investment decisions. Understandability in action, like UK airline detailed breakdown of fuel expenses coupled with explanation of cost fluctuations enhance the understandability of its financial statements. Even those without in-depth knowledge of the aviation industry can grasp the company's financial performance. Significance of applying accounting principle. In conclusion, accounting principle, relevance, reliability, comparability, and understandability serve as a cornerstones of transparent and informative financial reporting. So basically, in wrapping up, let's recognize the immense significance of these accounting principles. Relevance, reliability, and comparability and understandability. These principles serve as the bedrock of transparent and information and informative financial reporting. So in the UK, to provide clear and transparent information to their stakeholders with reliable, comparable, and comprehensible financial information. So the outcome: enhanced trust, well-informed decision-making, and thriving financial markets. So this in turn fosters trust, adds decision making, and contributes to a functioning financial market. Yeah, that's it for today. Basically, this was about regulatory framework of financial reporting, IFRS and IAS, standard board ASB.
Also, can I ask you a question? Can we get a copy of this presentation online?
Oh, you haven't got a copy of this presentation?
Okay, all right, thank you, sir.
Oh no, I mean that you haven't got a copy of this presentation already.
I haven't checked the last time I checked there was something like this, but I don't know if it's the exact copy.
Oh, okay. Just can you email me? Have you got my email? Anyone?
Yes, I got it.
Yasser@ukversity.co.uk. Okay.
Yeah.
Just drop me an email. So what I'll do that I'll email this presentation. Okay.
Okay, thank you very much, sir.
Any question, Faiza, Eli?
Yes, but I was wondering if there is a book that would help with all the international financial standards and all these.
Have you got a login and password for university?
Yes, I am on the website. I don't know.
Yeah, there are a few books.
It doesn't have anything about financial reporting.
Okay, what I'll do.
There's one course.
Which one is it? Is it financial accounting or just
tax? I believe
okay,
ATHE business tax.
Yeah, that's a different subject. Business taxes. Okay.
Yeah.
Nothing to do with financial accounting. So what do you do, Faiza? Just drop me an email. Okay, or just hang on, you guys.
Because the unit I'm doing is UK taxation and business, and
yeah, next. You are there as well, next 10:30 as well.
Is there another class at 10:30?
Yeah, 10:30 is UK taxation, business taxation.
Okay, cool. That's fine.
Okay, so
today,
what I'll do that, Eli and I'll just drop you an email. So what I'll do that, I'll check and email my this presentation and book as well. Okay.
Okay. Thank you.
Okay. Thanks very much for now, and see you in our next session. Okay.
Thank you very much. Have a lovely day.
You too.
Okay. Thank you.